Hey, what's going on, you guys? My name is Ian Richardson, and in this video, I'm going to be talking to you about the GameStop saga from beginning to end, or at least the current times. And first, you're probably wondering where I'm at right now. I'm actually back in Connecticut with my girlfriend and my brother watching my parents' 3 pups, and truly it could not get any better than this. Now, what did GameStop do to really garner all this attention? Not much. And in fact, GameStop over the last few years has been declining in its business model. And a big reason for that is the digital transformation of how people consume games. So in comes Wall Street Bets, which is a subreddit of internet retail stock traders that really make some of the most ridiculous trades and investment decisions I think the world has ever seen. And they are self-proclaimed degenerates. They have their own language. It's really its own world. And it's honestly like if Fight Club had an internet forum that instead of having Project Mayhem, they had Project Make Money. But instead of trying to make money, they lost a lot of it and then meme themselves. That's essentially what Wall Street Bets is. And in an unsuspecting way, a lot of them actually have some really great due diligence and have made quite a bit of money in the stock market. However, despite all of this negative press, some investors were still remaining optimistic. On Wall Street Bets, there was one self-proclaimed value investor, aptly named Deep Value, that actually believed GameStop could come back. In fact, back in 2019, he actually invested in GameStop via call options out into 2021 expiration and putting down almost $50,000 in this position, saying that he thought the stock was going to go up. Anyways, a year later, the same Redditor that I just spoke about posted a video on YouTube under the moniker Roaring Kitty and about his thesis on GME. And here's a quick clip.
It's July 2020 right now, and I'm bullish on GameStop at the current price point of about $4 per share, $260 million market cap.
Despite the few investors on Wall Street that were bullish or positive on the stock, most people thought GameStop would go the way of Blockbuster and Radio Shack with bankruptcy. So what did they do? They sold the stock short. So what is short selling? Well, over the last couple of weeks, I've seen a lot of people try to explain this fairly simple concept and really fail at it.
Now you owe your friend a ton of money, which you have to pay in Beanie Babies, which you can't get.
But instead, I have Margot Robbie here to explain it in a bubble bath.
So now he's going to short the bonds, which means to bet against.
No, come on, I'm totally kidding. I couldn't pull that off. But instead, you have me explaining this in a bubble bath. Think about it like this. Let's imagine you have student loans to the tune of $20,000. Instead of that student loan being fixed, it's basically now just tracking the value of the stock. So let's imagine that stock is Tesla, and Tesla goes from $100 a share to $1,000 a share. Well, your $20,000 loan is now $200,000, right? And so what are you hoping for it to do? You're hoping for Tesla stock to go down. And that's short selling. You think I could have gotten Margot Robbie? Hi. So enter the hedge funds. Now these guys overwhelmingly decide that GameStop is going to go bankrupt like Radio Shack and Blockbuster had in the past. And are they right? Maybe, but here's the thing about the stock market. There's a great saying that goes, the stock market can be irrational longer than you can stay solvent. In other words, you can be right, but it can be the wrong time. And here's where it gets interesting. These hedge funds were so sure that GameStop would be worthless, they collectively shorted more shares than there existed in the market. And at this point, you might be asking, how is that even possible?
Is that legal?
Let's just say that the people that bought shares and sold those short had those shares borrowed and also sold short, which were also borrowed and sold short. And I know what you're thinking, that makes no sense, but it's exactly what happened. And this is where it gets a little funny for me. So these so-called sophisticated investors, and this is actually a technical term, decided to short a stock, which is risky by itself, but in this case, a stock that had a market capitalization or the total value of all the shares outstanding of less than $1 billion. And I know for you and me, that's an insane amount of money, but when you're talking about money managers and institutional investors, it's not that much. And what's crazy is that a stock with less than $1 billion market cap is seriously exposed to being manipulated. And this is done all the time by hedge funds in ways that we're not super privy to as retail investors. So in essence, these hedge fund managers, they had one thesis. GameStop was going to go bankrupt, and it was going to happen in the near future. And they were so certain of it that all of the conventional wisdom held with risk management and so forth went completely out the window. Basically, these guys got overconfident. They thought that they were the smartest guys in the room, very similar to situations we've seen in the past with extreme market moves like in 2008 with the housing market collapse and in the 2000 tech bubble.
Wall Street loves to use confusing terms to make you think only they can do what they do.
So fast forward to December of 2020. Some positive news comes in. The Chewy founder comes ahead and joins the board of GameStop. And for those that don't know, Chewy is a e-commerce shop that basically sells pet food. And so he can bring a lot of that expertise to GameStop to make the business transition that they need to make in order to survive. And in addition to that, Microsoft and Sony released their new consoles that include discs. Now, the environment that we've already spoken about with a small amount of shares outstanding that can be sold and bought in the market, with a lot of new buying pressure, with people excited about this good news that's coming in place for GameStop, with also the insane amount of short interest in the stock itself, above 100% of the outstanding shares. All of this created a perfect storm, which led to a short squeeze. So what is a short squeeze, you might be asking? Well, it's really when you just give a big squeeze to your short girlfriend. But in reality, in order to talk about a short squeeze, we actually need to talk about something called margin. Now, in brokerages, there's really two types of accounts. For simplicity's sake, there are cash accounts and there are margin accounts. Cash accounts require you to be able to buy and sell stock, but wait for the settlement of that transaction. This takes 2 days in the current markets. Margin accounts basically are allowing you to trade on loan off the brokerage. So the money that you may have in there, let's imagine it's $10,000. You can trade $10,000 of the brokerage's money without having to wait for the settlement of those shares. And in addition to that, you can actually trade beyond the $10,000 you've invested on a loan that you basically pay interest on, basically to long or short stocks. Now that we know what a margin account is, let's talk about something else, which is called the margin requirement. Now, whenever you place a position, whether it is buying a stock or selling a stock into the open market, the idea is you have a certain amount of equity that you need to have in that account to be able to meet the margin requirement. Now, this is something that is basically can be set by the brokerage, but typically for a short position, it's around 50% of the outstanding short position. Now, let's imagine it's a $10,000 short position. You need to have $5,000 in cash in addition to the $10,000 you get up front to be able to hold that short position and be within the margin requirement. Now, this is where things get interesting. One more margin word. This is where you can have a margin call. Now, let's imagine you're short a stock, we'll call it GameStop, and GameStop decides to go up 100% and then 200%. Well, that 50% requirement that you need ends up becoming more money because the actual stock's value has gone up, and it often requires you to cover your short position. And all of this together with a stock like GameStop, the good news, the buying of people from Reddit, but also shorts covering their positions and responding to margin calls. This drives the stock up significantly in value, and you end up with a stock chart that looks like this. But anyways, part of the reason I've been just laughing over the last few weeks is because for the first time ever, retail traders have put themselves on the map. You know, the guys and girls around the country that are sitting in their PJs in their parents' basement that are buying and selling shares of stock and basically holding these hedge funds to account for poor risk management measures are like setting a revolution. And I think what's interesting about it is the guys that started this, their due diligence was pretty great. I mean, for anybody to have said GameStop back in, August of 2020, less than 6 months ago, was going to do this, it would have been a crazy idea. The media had been one of the first to report that Melvin Capital, one of the largest short investors and hedge funds in this entire realm, had closed their position. Now, the hard part about this is hedge funds have an ability to be able to show that they have closed their positions without actually doing so. And there's plenty of techniques that they can use, pretty complex in nature. I'm not going to explain them here because there's not really a point to do so, but ways for them to be able to kind of show that they're not short anymore, but still hold that position. And whether that's the case for Melvin Capital or not, I don't know, and I'm not purporting to say that. But I'm sure for a lot of hedge funds, they were able to do something along those lines and hold the position long enough to be able to basically ride out the severe volatility and this incredible amount of buying pressure on this stock. Now, in addition to that, we also have brokerages, and the one I want to speak about is Robinhood. Now, Robinhood is typically the choice for new traders, and the reason is it's got $0 brokerage fees when you're trading stock and options and so forth, and they were the first to do so, and they purport themselves as the brokerage for the people, by the people, and so forth. Now, here's the problem with that whole statement. They don't make money from the people that are their brokerage users. In fact, Robinhood, as the CEO talks about, is actually a holding company for 3 divisions, if you will. One of which is the brokerage that people know and love. The other of it is actually a clearinghouse where they're actually basically selling the order flows to hedge funds, institutional investors, and so forth, and making money on that side of it because they don't actually make money on the brokerage. And there's also another wing as well for crypto. So here's the thing. Very similar to like a Facebook. If Robinhood's not actually making money off of the end users, then are the end users the product? Now, fast forward to this GameStop short squeeze hype, right? And Robinhood on the Thursday where GameStop hits an all-time high, they're put in a situation where they need to restrict their users' ability to buy the stock. Now, if you only give people the option to sell, what do you think they're going to do? Probably sell, right? So this put a tremendous amount of selling pressure on GameStop, where there had not been much before, because the thesis, as laid out by the Reddit users and so forth, had been true, that there were more shorted shares than there were outstanding, and a short squeeze was imminent and could pretty much go to wherever they wanted it to as long as they weren't going to sell. And so this had a lot of people very angered, and rightfully so, and asking the question, why did they have to do this? Was it a liquidity issue? Was it something else? And in a huge turn of events, basically that night, the Robinhood CEO jumps on to an impromptu interview on Clubhouse with Elon Musk, and they go through all of this.
Glad the stock impaler.
Basically, what ended up coming out of this is that Robinhood and a lot of other brokers had a situation where the capital requirements that they needed for their clearinghouse part of the business were much higher given the volatility and the amount of buying pressure that was going on in the market for the capital requirements for the DTCC. And it kind of exposed a serious issue in the financial markets, which is that settlements are still super antiquated. And the way that actually works is a problem, right? It shouldn't take 2 days when we have the technology today to make it real time. And that's really kind of at the core of the issue, at least according to Robinhood. Now, I don't want to pick on them. There were other brokerages that had to also restrict buying. And part of the reason for this was so that they could minimize the amount of capital requirement that was required to the DTCC. And there's so many conspiracy theories that have come out here that haven't been validated, but also I can understand people's inclination here. You know, obviously it would be in the hedge fund's interest for the lack of buying to be allowed for a lot of these stocks that they were short in. So you kind of look at this and you ask yourself, is Robinhood acting in good faith here? Or was it actually the story that Vlad, the CEO, is telling? Is that true? Or is there something different actually happening on the back end? Once again, I can't really tell you. I don't know. And this is all my speculation. This is only entertainment purposes only. Please don't sue me. Okay. So funny enough, other interviews happen, right? One of the interviews is by YouTuber Meet Kevin, who goes ahead and asks Vlad the question, do you think blockchain would have fixed this issue? And I thought that was interesting because this has been discussed for a while now, whether blockchain, the technology, could be a way to have a real-time settlement system for the financial markets. And Vlad kind of dodges the question. What's interesting about this is you almost have to ask yourself, would that be disadvantageous to the way that they actually make money? Why is that something that he wasn't necessarily on board with? But anyways, it's to say that for those of you that are new to trading, that are new to the markets, I'll tell you this, the financial markets are incredibly complex. The brokerages are not really the ones that allow you to trade. It's people well beyond them that do. And the more you think about it, you want to be trading with a brokerage that is mature and has the large balance sheet to be able to withstand this type of volatility and pressure, and allows you to make the right decisions for yourself. Unfortunately, it doesn't seem like Robinhood is at that place right now, but I guess that remains to be seen, and I guess we'll find out. In the end, is this the first short squeeze that's ever happened? No, it's not, and it won't be the last either. So then why is it important? Well, there's a few reasons I think this is an important thing to really understand deeply. One of which is that the SEC is now investigating Wall Street Bets, the Reddit forum, and looking into potential manipulation and so forth that existed that led up to this massive short squeeze in GameStop and a bunch of other stocks. Now, what's interesting is that this seems like a bit of a double standard. If analysts are able to come out and say, the price target for some random stock is 100% over where it is right now, and also be able to hold a position in it, if Cathie Wood's able to say that Tesla's going to 4,000, why can't retail traders? And so it seems like we're operating on two levels of rules here. It'll be really interesting to see what happens off of that SEC investigation. And I'm hoping that the little guy here doesn't get screwed based off the fact that they're just not the ones that are kind of the protected few like Wall Street has historically been. Should Robinhood be trusted? Which is another, I think, fair question. And I think that remains to be seen. Unfortunately, they're in a position where they're still a startup. They're still a private company. They don't have access to public markets. They don't have as much access to capital. Their balance sheet's much smaller than a lot of these other brokerages. But is that any excuse to basically throw your users under the bus and put them in a situation where they could potentially lose money or did lose money because of the fact that they restricted the ability to buy stock? I can't answer that question, but I think it's going to be very interesting to see how that unfolds over the next few months. So who won? Now, unfortunately, this is a pretty hard question to answer. If you had asked me a week ago, I would have told you the retail traders, but since then, GameStop's down 80%, and now we're at a place where both retail traders and hedge funds have won and lost. But I'll tell you this, what's incredibly interesting about this entire thing is that the retail traders, the so-called dumb money, were the ones that were able to stick it to these hedge funds, the ones that took for granted the risk management that they should have been doing against these massive short positions on stocks that were low capitalization. All of this together is to say, it's hilarious that the people that were looked down upon by these hedge funds were the ones that were able to stick it to them in the end. I think for me, it's been interesting to watch this mostly from the sidelines and be able to learn a lot more about the markets than I knew myself. Hopefully this was interesting and informative for you. Hopefully you found some humor in this as well. And hopefully if you're just getting started in the markets and you're just getting started as an investor, hopefully this has been an educational time for you, and that short squeezes are not your immediate calling, and maybe you can get involved more from a long-term perspective and figure out how to buy stocks that actually do have some intrinsic value beyond, squeezing out the shorts. And with that, I hope you enjoyed this. If you did, please go ahead and give this a like and subscribe to my channel. I'll be posting videos like this every week around investing, personal finance, and career growth. And with that, hope you enjoy the rest of your weekend. Peace.